Hello, ladies and gentlemen. Hope you're doing very well. Today we are going to cover a very interesting topic. In fact, okay, I'm not going to speak about gold or any of these things that the retail traders actually focus on. I decided to speak about something different, whether is it different from, the normal discussion about the dollar index, about the gold, about the silver, about the Bitcoin that everyone speaks about. I decided to take the US market and whether is there a crash that's really happening soon because of the AI bubble that everyone speaks about it. So in this session, I'll try to cover as much as I can from the indicators, from the history, and what are the future looking to the US market. Okay. And at the end of the session, I'm going to ask you guys, do you think that there is a crash that's happening or not? And if yes, then how can we avoid this crash? Okay. So I'll start with, will the US market crash soon or not? So in order to start this topic in a structured way, first of all, I need to tell you guys that we as technical analysts or we as a traders, we usually focus, or the technical analysis has taught us that in order to predict the future, in order to know the future, we need to study the history. So if I want to answer this question, will the US market crash soon or not? I need to have a look on the history, first of all, and I'll study the patterns that happens in the history. I'll check the indicators. I'll check everything surrounding the crashes that happened in the past, and I'll try to apply the same concept in the future, which is in 2026. Then we will reach to the conclusion. I'm not going to evaluate this only fundamentally, but also I'm going to go through the chart and I'll try to analyze S&P 500 technically. Let's see the zones and let's see if there is a really crash that is expected to happen or not. So let's talk about the history first of all. So guys, we have been facing, or we have witnessed, a lot of crashes that happens in the US stock market. Starting from 2000, 2002, the dot-com bubble, and then the 2008 global financial crisis, and then the COVID crash, and then we ended with the 2022, the Fed rate hikes. Okay, so these are the main crashes that happened in the last decade. So what was the actually performance of the S&P 500 in these four crashes? So the following timeline, the red timeline that I'm showing to you here, this represents the performance of S&P 500 in each single crash. So let's see what happened in the dot-com bubble. In the dot-com bubble, S&P 500 has decreased around 49 or 50% from its value. Okay, I'll speak about the main reason for the dot-com bubble. And we guys know that in 2000, 2002, or the dot-com bubble, the main focus was the internet. Okay, so guys, that's really important because we need to know what was the reason for the crash, right? So the internet, everything was the main focus for all the audience, all of the people, all of the traders, all the investors. We are introducing the internet. Okay, so this happened in 2000. In 2008, this is apart from the stock market. This is related to the mortgage and the real estate prices. S&P 500 has lost around 57%, although this was something that is indirect, but unfortunately, when a crisis happens and hits all of the system, we know the domino effect. Everything will fall. So S&P 500 wiped out around 57% of its value. And then COVID crash, S&P 500 lost around 34% of its value. And 2022, when the Fed decided to increase the rates, S&P 500 lost around 27% of its value. Now, these are the main crashes that happened in the past 2 decades. But I'm not here to tell you that these are the crashes and this is the performance of S&P 500. No, I'm trying in this session to figure out what is the reason for every single crash, and whether is there any common thing that is actually happening nowadays and we are not aware of it. Any common thing that is happening nowadays while we are having this session. Is there something happening and we are not actually take care of it? We are not aware of that thing. And once we figure out these things that is common among all of these four crashes, we will learn, or we will see, or we will conclude whether the crash is happening soon or it's not happening. You guys will decide. Okay? So, first of all, the question is, what did all these crashes have in common? Okay, so there is nothing, I would say, one single factor that is affecting the S&P 500. There are multiple factors that are affecting S&P 500. From the crashes, I have studied and I made a lot of research, and I'm trying to summarize all of these research in these 30 minutes or 40 minutes that we have together. So, number one, when we speak about a common factor among all of these crashes, we are going to speak about the valuation. So I want you guys to ask you a question, and I want you to reply in the chat box. Do you guys know what do we mean by the concept of valuation, or no? Because if no, then I need to explain to make the picture really clear for everyone who attending this webinar. Are we aware of what do we mean by the word valuation or not? No. Okay, that's great. That's great. Fantastic. Perfect. So, kindly explain. I will. So Razak said no. Valuation, guys, means to find the real prices of something. If I told you there is a Range Rover, brand new car, okay, it is in the used market. You open Facebook or whatever, and you found a brand new Range Rover that is around, let's say, $50,000. Okay. You know that the market price of that Range Rover is $150,000. Okay. The car has no defects. The car is brand new. The car, it's not used, but you found the car at $50,000. Okay. And everyone else in the market is selling the same exact car for $150,000. Let me ask you guys a question. If you found this deal in the market, will you buy this Range Rover on Facebook or not? Is it a good deal or not a good deal? Of course, it's a good deal, right? Why? Why it's a good deal? Because this car, actually, it is undervalued. So what do I mean by that car? It's undervalued. This car worth more than it deserves. This car worth more than it deserves. So this car for me is undervalued. Okay. But if you know that the average market price of Range Rover is $150,000, and you found another Range Rover that is cost $300,000, let me ask you a question. The same question. Would you buy this car or not? Of course not. Why? Because this car, it has a value that is more than its average market prices. So if I bought that car, what will happen? I will have to sell it. I will buy it at 300K and I'm going to sell it at 150. So here I lost, right? Why I lost? Because simply this car is overvalued. Okay. So this is the concept of the valuation. There is two prices. One is the real value, what actually the asset worth, and one is what is actually the trading price. What is the current market price? If the real value of that car or the asset is more than the market price, we say that the stock is underpriced, and vice versa. So we usually, as traders or as long-term investors, we should understand, and we should calculate what is the value of the asset before we decide to invest in it. Is it worth it, or it does not worth it? So this is known as the concept of what? Of the valuation. Now, so guys, in a summary, if you have something that is overvalued, what do you expect will happen to this asset? Is it going to drop in value, or is it going to increase in value? I just need very simple answer, up or down, if it's overvalued. Come on, guys, anyone, please. You can make wealth if you understood what's going to happen next. So if something is overvalued, it has more price than it's worth, okay? Are you going to buy it, or are you going to sell it? Okay, it's overvalued, okay? So the value is actually more than the price, so I don't need that thing, because what I'm expecting that this thing is going to drop. It's going to back to its real value, right? So now I'll apply the same concept. Thank you guys. Yeah, we're going to sell it. So I'm going to apply the same concept here when it comes to S&P 500. Now we know the S&P 500 is composed of the largest 500 stocks in the market, okay, in the US market. Those 500 stocks, they are components of S&P 500. So whenever, on average, the prices of these assets goes up, S&P 500 will go up. On average, if they go down, S&P 500 will go down. Now, those assets inside the S&P 500, those 500 stocks and S&P 500, are they overpriced or are they underpriced? The question is, this is the question, okay? Overpriced or underpriced? Now, you'll tell me, how can I do this for 500 stocks? Now, we all know Warren Buffett, okay? The richest investor all over the world, Warren Buffett, okay? So Buffett, because he's interested in focusing on or investing long-term in stocks, he has created something called Buffett indicator. He has created something called Buffett indicator. So what is this Buffett indicator? Now I'll jump to the chart and I'll explain to you guys what is Buffett indicator. So I'll show to you, this is S&P 500, okay? And I'm gonna add the Buffett indicator. This indicator actually, guys, shows in a very simple term, if the price is over 100, so the 100 is the average, okay? If the indicator shows a value above 100, this is overvaluation, which means we are expecting something to go down. We are expecting a crash. But if we are below 100, this means that we are in undervaluation, which means we are expecting the prices or the asset or the stock to go up, okay? So if we come here to that part, okay, and let's see the analysis of S&P 500 throughout all the crashes that we just explained, okay? So first of all, I'll just use the tool here to draw. So guys, you can take care of what I'm doing actually. So this is S&P 500 on a monthly chart, okay? Now, if we come here to 2000 and 2002, we can see here the first crash. And this first crash, actually, this is the dot-com bubble, okay? And this was because of the internet, okay? So this is the dot-com bubble. This is the crash that happened in S&P 500. Now, I want to see what is the value of the Buffett indicator at that part. So we guys can see here that Buffett indicator in the dot-com bubble has reached almost how much? 125 or even 100, yeah, 125, which means that this indicator is showing that we are in overvaluation. And once the overvaluation happens, because everyone was investing in the stocks of the companies that are building the internet infrastructure at that time. So everyone was starting to invest billions of dollars. And at the end, what happened? It was a bubble, and then we saw the crash. Another crash that happened is 2007, 2008 financial crisis. And actually here, there was no overvaluation because this was related to something else, related to the bonds and the mortgage-backed securities. So I'm not going to focus actually more on this, but we will see here, this is the global financial crisis. Okay. Now, then we have the COVID period in 2022. Okay, sorry, 2019, 2020. Okay, here we have the COVID, and we can see in that level or in this crash, we can see that Buffett indicator has reached 161. Imagine what happened after we have overvaluation of 161. I need your answer, guys. What happened? What happened to the market? So we can see here 161 overvaluation, the market crashed again. Okay, another example, 2022 rate hikes. Okay, we can see also same thing, 161, another crash. Now, guys, where are we? We are sitting here. We are here, 2026. This is S&P 500 currently running at the moment, live when we are speaking. What is the value of the Buffett indicator? It's almost 194. 194, which means that the companies in S&P 500 are overvalued by 94% more than the average. So guys, the first question, and I want everyone to answer me. If this indicator, we've proved that in all of the crashes, this indicator shows that overvaluation, eventually the market will crash. Now, the highest number ever among all of the three crashes that we spoke about, this is the highest value of Buffett indicator. What do you guys are expecting? A crash or nothing is going to happen? This is one thing that you guys need to think about it. Number one, check the Buffett indicator. Okay? Is that clear, everyone? Is that clear? All good? A crash, yes. Now people started to confirm that there is a crash. We are just studying the history. Okay? I studied the history. I am planning for the future. I'm not doing anything. Yes, market will crash. Now everyone sees because we have an evidence. So everyone is expecting the market will crash. Okay. Let's hope for the best. Let's hope that the market will not crash, but there is a one red signal that we are having here. Done. So this is number one, which is the valuation. Okay. Now I'll come back to the slide and I will check another fundamental factor. Okay. Fundamental ratio. So guys, in the normal finance, okay, when I want to see, or I'll just give you a quick example. So I don't want to waste your time. If I told you guys that I have two stocks, stock A and stock B, we have a ratio called the price to earning ratio. Price to earning ratio. So what is it? This ratio simply means that if I have a stock, the current price of the stock is $10, and that stock is paying for me dividends. It's paying for me earnings as an investor, $5. The ratio is 2. Stock number B, okay, the price for that stock in the market currently is 5, but it pays for you $10. Okay? Let me ask you a question, guys. Do you prefer to buy something at $10 to get a profit or to get some returns, $5? Or do you prefer to pay from your pocket $5 and you get in return $10? Which one is better? Which one is better for you guys, A or B? Of course, I would like to, Mushahid, I think it's A. So you prefer to pay $10 to get $5? Or do you prefer to pay $5 to get $10? Of course, I would like to pay $5 to get $10. Of course, right? So for me, here in this part, A is an overvalued stock. B is undervalued stock, right? Because I am paying less and I'm getting more. Okay? But here in stock number A, I am paying more, but unfortunately I'm getting less. So what I need with the stock? Why I'm paying a lot of money and get nothing in the return? Okay? So of course, B is better, right? Now, this PE ratio works in normal stocks. Like we are not adjusting the inflation. We are not adjusting the time value of money. That's a long story for economists. So there is another ratio that is known as CAPE ratio. So this CAPE ratio means what? This CAPE ratio, it's the normal PE ratio that I've just explained, okay? This CAPE ratio, actually, if it's higher than 25, you know what does it mean as an interpretation? It means that the companies are promising earnings. They promise earnings, but actually there is no earnings, okay? The prices are going higher and the companies are promising to pay for you high income. But the reality is there is no income, there is no profit, there is no dividend, there is nothing, okay? So the CAPE ratio uses its equation, the concept of the PE ratio, to show that the stocks are overvalued or undervalued, right? Now, do you think, guys, the CAPE ratio in dot-com bubble, if I told you, do you think it was above 20 or below 20? What is your expectations? So above 20 means we are just getting a promise to get income. We are very optimistic that we are getting income, but in reality, there is no income, okay? So what do you think, guys? In dot-com bubble in 2000, do you think the CAPE ratio was above 20 or below 20? What do you think? Above 20. So you guys are agreeing that in dot-com bubble, because of overvaluation and the companies, people are investing in the companies, but they are not getting anything in return, the CAPE ratio was high. So what if I want to see if there is a market crash or not? Then let's see the CAPE ratio in 2026 and compare it with the CAPE ratio in 2000 and 2002. So I'll come here and I will go to CAPE ratio, this one, right? I hope, guys, you can see the CAPE ratio here, okay? So that's called Cape-Shiller PE ratio. It's the same thing. So it's called Cape-Shiller PE ratio, right? So here is 2000 and 2002. Guys, can you see how much is the CAPE ratio? It's 41.96. 41.96. This means that people are willing to pay 40 times what they will receive. They are willing to pay 40 times what they are willing to receive, okay? So I'm gonna pay $40 and I can get $1, okay? So that's an overvaluation. Now, guys, if this is happening in 2000 2002. And also, apart from the financial crisis in 2008, if we checked in the COVID in 2019 and 20, it was 29. Now we are in 2026, right? Okay. So in 2026, July, what is the Cape Shiller ratio? It's 40.57. What does it mean? People are willing to invest in AI companies billions of dollars. Okay. They are willing to invest 40 times what they are wishing to receive as an income. What does this mean? A very simple, very clear overvaluation, right? So we can see the second confirmation here. Is it interesting, guys, that the same thing, the same bubble that happens because the internet was an invention in the market and everyone was waiting for the internet to crash the market and to know, the internet will do everything. The history repeats itself, but with the AI. Same thing, almost. Okay? 2042, and now we are in the 40s level. This is the factor number 2. Okay? Did you guys understood the concept here or not? So what do you guys are expecting? A second confirmation, okay, from the history, a second confirmation from the history that we are expecting a crash. Okay, guys, all of these indicators does not mean that tomorrow we will wake up that S&P 500 is in crash. No, but we are preparing for what might happen. Okay, that's perfect. Now I'll come back to these slides again. Okay, number 3. In every single crash that happened in the market, we need to check the psychology of the investors, because the reasons for every single crash, it is the people sentiment. It is the psychology. What are the people think? What are the people, expecting in terms of what they are investing to? So these are the crashes, okay, that we had in 2000, 2002. We had the dot-com bubble. If you reviewed the history, please go back to the history and see what people were saying about the internet. Internet will change everything. Internet companies are going to be the largest. Internet companies will do what human cannot do. Okay? Everyone, internet, 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 internet. People started to invest in the internet. Billions of dollars are in the internet companies. What happens after that? A crash. So the psychology is important as well. We're not just focusing on the indicators, on the fundamentals. We are focusing also on the psychology, because if we need to study a pattern, if we need to study something, we need to check all of the aspects. We need to study the ratios. We need to study the GDP. We need to study the fundamentals, and we need to study the psychology. In 2008, they said, housing prices never fall. Have you ever seen the real estate market prices goes down? Of course, no, that's not going to happen, right? And you know what happened? The market has crashed because of real estate. That what happened in 2008. 2008, because the United States economy, they said, we are going to make America great again, and we have something called the American dream. What is the American dream? That no one is going to rent. Okay, there is no American citizen is going to rent a house. Everyone will own a house. So they said, what if we issued some bonds, okay, with the packet of mortgage, okay, secured by mortgage, okay, because anyhow, if the person who got the loan, or the borrower got the loan, he didn't pay, so what? We are gonna sell the real estate or the property, and that's it. And the prices of the property is always increasing. People started to default. Banks started to sell the real estates and the properties. A lot of selling pressure happened. The real estate prices goes down. The market collapsed. Very simple. So it happens. In 2021, in the COVID time. They said meme stocks only go up. So the meme stocks are the stocks that people are thinking about or people are speaking about when it comes to the social media, right? So there was a real story that happened in 2020 in the COVID crash when everyone was speaking about the GameStop stock. So have you guys heard about the story of GameStop stock or not? I'll just mention it here, maybe GameStop stock. Okay, so GameStop stock is one of the real case studies that you should take it into consideration because people said, okay, we are in COVID. Now let's talk about what? Let's talk about some stocks. Let's take these stocks to the moon. Okay, so when people started to speak about these stocks on the social media, on the Reddit groups, on Facebook, on Telegram, and they're making some, lives on YouTube, these stocks are going to fly to the moon, right? So what happens is we have this stock, which is GameStop stock, because people, okay, they took this as a challenge with I would say, I'll just bring the daily chart. So it's going to be easier for you guys to see the effect. Okay, this company was actually crashing. As you can see. Okay, so this company was getting liquidated. They will defaulted. As you can see, the price of the stock started from $14. It's going down, 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 down until it almost reached $1 or even 0.8 cent. But people started to speak about this on the social media. What happened? Okay, do you think, guys, if a stock that is worth $1 and the company is facing financial troubles, do you think how much the price of this stock can reach to? Just let me know. Anything, any guesses? A company collapsing, a company is defaulting. The stock price currently is $1. How do you think, okay, or what do you think the price of this stock will reach to? Any guesses? Above 100, above 50, above 20, above 30? What do you think, guys? Because of the social media and because of the meme stocks and because a lot of people at the COVID time, they lost their jobs. So they wanted something to invest in. So everyone agreed to invest in GameStop because this company has a popularity among the young people. So they created some Reddit groups and they spoke about the GameStop stock until, as you can see, the stock price increased up to $87 in very 2-3 weeks. And as you can see here, guys, the Buffett indicator shows that this stock is overvalued by 157%. Okay. And whenever Buffett indicator shows you a percentage above 125 or above 100, what's going to happen? It crashed again. Okay. So this is another concept of overvaluation. Now, as we are speaking in 2026 currently, the overvaluation of this company has reached to 193. What I'm expecting in a very, very simple thing, that this company is going to be liquidated and this company is going to have a crash soon, very soon, and maybe the stock value is going to be zero. Okay, so this is another case. The fourth case in 2026. What do you guys expecting the case in 2026? What do you think people are saying in their mind from the psychological perspective? What do you think they are saying from their mind? What is the main focus at the moment? Can anyone tell me what is the main focus for people right now? Thank you so much, Mushahid. It's the AI. Okay, so when people are seeing that S&P 500 that's driven by the AI companies, they say, okay, that's AI, man. AI is going to replace human. AI is going to do whatever people cannot do. All the companies, all the businessmen are using AI. If you're not using AI, you are going to, be kicked out of the market, right? So this is, people are saying, okay, overvaluation. This is not overvaluation. AI justifies any valuation. That's an AI. Remember, AI, internet at that time, and AI, same psychology, same thing, right? Here we got Buffett indicator, we got the CAPE ratio, almost the same. 2026, exactly, Buffett indicator, CAPE ratio, psychology, how many confirmations that we have, how many signals that we have that we are in a market crash. 3. Okay, exactly the same, right? Okay, perfect. And every time when we study the history and we say, no, this time is different, this time is different, this time is different, every single time this happens, what happened, guys? The history proves us that we are wrong every single time. Okay, now I'm not wondering that Warren Buffett has sold most of his stocks, okay, and he is keeping the cash at the moment. This is another important signal. The Buffett indicator, the CAPE ratio, the psychology, everyone speaks about the AI. All of these are signals for me, because when people speaks about something and they focus on that and they are willing to invest more in this thing without having the tolerance or the willingness to receive income from that thing, that's why we have bubble. This is how the bubble is created in the market. It's a small thing, AI. We started with a ChatGPT, and then we have cloud, and then we have other things and other things and other things, and the bubble started to form. Once the bubble reached its maximum, one single click, then thank you so much, everything will crash. Okay, so this is the fourth thing. The fifth thing, or the fifth confirmation that we can see here, it's the risk of concentration. If we compare the internet.com, and I'm focusing mainly on the internet.com prices, because it's something like related to the fintech or technology, which is the internet. And now we are in the era of AI, which is also a fintech or technology. So I'm trying to combine or to compare both of these two periods of time so I can get a conclusion, a clear vision, a clear conclusion, what's going to happen. So if we compared S&P 500 in 2002 and 2000, S&P 500, although it has 500 stocks in this index, okay, there were only 4 big companies that dominating the index. Okay, so imagine, I do have 500 stocks. Like, there is a company that has 500 employees and only 4 employees who attend every single day and they do the work for the 500. Okay, do you think this is acceptable? If there is a company that has 500 stock, 500 employee, and only 4 of them, they are working hardly and they are achieving their targets and they are doing the entire job, do you think this company, guys, is going to survive? I need an answer, yes or no. 4 people out of 500, they are doing their jobs. Do you think this company is going to survive? Yes or no? What do you guys think? No, 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 no. Of course, no, right? Because eventually these 4 people, either they are going to be burnout, they are going to resign because they cannot work and they're taking the same salaries as 500 person or the other 496 person, and they are doing the entire job. So, right? So what will happen? This company eventually is going to crash. Now imagine that the largest index in United States of America, which is S&P 500, is dominated by 4 companies. And this was in 2002, the dot-com bubble. The same thing, it is applied nowadays in 2026, okay? In order to say that S&P 500 is actually growing up, okay, in a healthy, bullish market, I need to make sure that if S&P 500 is making higher highs and higher lows, I need most of the companies in the 500 stocks, they as well making higher highs and making higher lows. But what if I told you that most of the companies in S&P 500, they are downtrending, and only 4 of the 500 stocks, they are making higher highs and higher lows, which means they are taking the momentum with S&P 500. So these 4 employees, okay, are the ones who are doing the job. For whom? For the remaining 496 stock in the index, which means there is no participation, which means that these companies that are investing mainly in AI, we are concentrating on these companies, okay? S&P 500 is having the risk of concentration on these companies. So, 5th signal. Okay, now, in order to conclude this, before I conclude and to check the checklist for the signals, I'll just go quickly here. I'll remove this. I'll do just a quick technical analysis for the S&P 500. Okay, so I'll just draw this on the, I'd say, monthly chart. Okay, so this is the monthly chart of S&P 500. Okay, and if I'm applying Fibonacci levels in order to see the zones, okay, on the long term. So as you can see, guys, that we are continuously, okay, if we started from that low, so we have made a high, we have made a low, higher low, and then higher high, higher low, and then we have a higher high, higher low, and then a higher high. Okay, so this is the trend for S&P 500. It's going up. Yes, it's going up. But the focus is here. As you can see, guys, that now we are having a resistance at the level of 7,607, right? So the potential, if the crash happened, okay, we are going to test this level again, which is 6,597. And then if the crash is really strong, we are going to reach to that level, which is 5,974, because it's really clear that every single time that there is a market crash in S&P 500, it is getting tested, okay, among 2 zones in the Fibonacci levels, right? So we have here 38% and 61. So if it happens here, it's going to be between the 0 and the 23%, okay? Who knows? It might come back to 4,964. These are the expected zones that if the crash happened, okay, just keep it in mind, guys, that these are the zones that we can anticipate S&P 500 to reach to, okay? So we have 6,500, we have 5,900, and the worst case scenario, it's 4,960%, okay? So technically speaking, we should be testing this zone, okay? Maybe this year, I don't know, especially if the interest rate decision today was to increase the interest rate. The Federal is going to announce this after, I would say, 2 hours from now. So if the interest rate goes up, stocks will go down, and maybe there will be the direction for the market to crash, okay? Okay, so the last thing to conclude, the checklist for the crash is completed. Yes, let's see. Elevated evaluations. Are we on overvalue positions? Yes. Buffett indicator? Yes. Concentration in mega cap stocks? Yes. AI optimism? Yes. Higher interest rate? We will see today. Okay, just 2 hours to confirm yes or no. Okay, this is the checklist that we need, guys, to. Okay, it's almost done. We just have one remaining part, which is the interest rate, because Trump says that he will cut the interest rate. The federal, he knows that the inflation is at the peak level because the war has started again. And this might lead to, of course, they need to increase the interest rate, or I would say they will keep it as it is. But my expectation, it will go up by maybe 25 pips. So that's it from my side. Just as a confirmation, guys, this is just a educational content. I'm not saying that there is a market crash. I'm just told you that, guys, you have to check these indicators, these historical things, the index, the volatility index, the fear index, all of these ratios, you need to check it. And because mostly the confirmation or the signals around any crisis, it is exactly the same if we go back to the history as I proved to you. So I don't know exactly when the market crash is going to happen, but I just want to make an informed decision rather take it than taking it emotionally and just hear someone saying that the US market will crash. So it's better to study if the market's really crashed or not. Okay, that's all from my side. Thank you so much.